You work hard for your money. You diligently put a piece of every paycheck into your savings account, thinking you're building a secure future. But what if I told you that by playing it safe, you're actually getting a little bit poorer every single day? It's not a trick, it's a silent, relentless force called inflation. Think of your savings account like an ice cube you left out on the counter. Even if you don't touch it, it's slowly melting away. That's exactly what inflation does to your cash. The prices of everything, from your morning coffee to your monthly rent, are creeping up, and that means the buying power of the money you've saved is going down. If your bank is paying you 1% interest, but inflation is humming along at 3%, you are losing 2% of your money's value every single year. It feels like a rigged game, doesn't it? But what if you could not just play the game, but actually start winning it? In this video, I'm going to show you the only 4 investments you need for 2026. This isn't about wild crypto gambles or complicated strategies only a Wall Street guru could understand. This is a simple, proven blueprint designed for total beginners. It's not just about protecting your money from that melting ice cube effect of inflation, but actually building real long-term wealth. Stick around, because we're getting into it right now. Before we jump into the 4 investments, we need to fully grasp why that old advice to just save your money is dangerously outdated. For generations, that was the key to financial security, and for a while it worked, but the world has changed. Inflation is just a fancy word for the rate at which prices go up, making your money less powerful. Let's make this real. Imagine you have $10,000 saved up today. If inflation is 3.5% this year, that $10,000 will only buy you what $9,650 buys you today. You haven't spent a single dime, but you've lost $350 in purchasing power. Poof, gone. Over a decade, that effect snowballs, and the value of your savings gets crushed. This isn't a scary story, it's just math. Sticking all your money in a standard savings account is like trying to run up a down escalator. You're putting in all the effort, but you're just not getting anywhere. You feel like you're doing the right thing, but you're slowly falling behind. This is the exact problem that investing solves. Investing isn't about getting rich quick, it's about putting your money to work so that its growth outpaces inflation. It's how you turn that melting ice cube into a snowball that grows bigger and bigger as it rolls downhill. So, let's start building that snowball. Investment number 1, your financial fortress, the high-yield savings account. Alright, our first move is the simplest and safest of them all. And I know I just spent 2 minutes telling you why savings accounts are a problem, but this is a very specific and crucial tool, the High-Yield Savings Account, or HYSA. Think of this as the foundation for your entire financial life. This isn't your main wealth-building engine, but it is an absolutely essential first step. An HYSA is exactly what it sounds like, a savings account that pays a much higher interest rate than the sad, pathetic 0.1% you get at most big traditional banks. Right now, you can find many online banks offering HYSAs with rates in the 4 to 4.5% range. Why is this a big deal? This is where you build your emergency fund. This is 3 to 6 months worth of living expenses that you do not put in the stock market. It's your safety net for life's curveballs, a job loss, a medical bill, or a car that suddenly decides it's had enough. By keeping this cash in an HYSA, you do 2 critical things. First, your money is safe and sound. These accounts are FDIC insured, meaning the government protects your money up to $250,000. Second, while the market zigs and zags, your HYSA is consistently earning an interest rate that actually puts up a decent fight against inflation. It's the perfect low-risk home for your emergency fund and any short-term savings. So, before you even think about stocks, open an HYSA. It's the bedrock of a truly smart financial plan. Investment number 2, own a piece of the economy, S&P 500 index funds. Alright, now that your fortress is built, it's time to start building your skyscraper. This is where the real long-term growth happens. For most people, especially beginners, the single best investment out there is an S&P 500 index fund. Sounds fancy, right? It's not. An S&P 500 index fund is just a big basket that holds stock in the 500 largest, most profitable companies in the US. We're talking giants like Apple, Microsoft, and Amazon. Instead of trying to guess which single company is going to be the next superstar, which is basically impossible, you're buying a tiny slice of all of them at once. Boom, you're instantly diversified. When you own an S&P 500 index fund, you're betting on the long-term success and innovation of the entire American economy, and historically, that has been a fantastic bet. Over the long haul, the S&P 500 has delivered an average annual return of around 10%. Sure, some years it's up and some years it's down, but over decades, the trend is powerfully upward. The easiest way to own this is through a low-cost ETF or exchange-traded fund like VOO or SPY. They have ridiculously low fees, so more of your money is actually working for you instead of getting eaten up by some fund manager's bonus. The strategy is simple: buy consistently. Every week, every month, just keep adding a set amount. This is called dollar cost averaging. It's a beautiful automatic system where you buy more shares when prices are low and fewer when prices are high. It takes all the emotion and guesswork out of it. For long-term growth, there is no better or more reliable engine for a beginner. Hey, real quick, if you're finding this helpful and the light bulbs are starting to go on, do me a huge favor and hit that like button. It seriously helps the channel grow and tells me you want more videos just like this one. Alright, now let's talk about an investment that literally pays you to own it. Investment number 3, get paid while you wait. Dividend ETFs. So, you've got your safe emergency fund and your core growth engine. What's next? Let's add an investment that sends you regular cash payments just for owning it. This is the magic of dividend investing. A dividend is simply a piece of a company's profit that it gives back to you, the shareholder, as a thank you for being an owner. These are usually paid by stable, powerhouse companies. Think names like Coca-Cola or Home Depot that generate tons of cash and share the love with their investors. Now, just like before, trying to pick individual dividend stocks is tricky for a beginner. That's why I recommend starting with a dividend ETF. A fantastic example is the Schwab US Dividend Equity ETF, ticker symbol SHCD. This fund holds about 100 high-quality dividend-paying stocks that have a rock-solid history of not just paying, but growing their dividends over time. With an ETF like SHCD, you get a 1-2 punch. First, the share price itself can go up over time, but second, you get a regular quarterly cash payment. Right now, a fund like SHCD pays a dividend yield of around 3.5%. You can take that cash as income, or, and this is the pro move, you can automatically reinvest it to buy more shares. That's how you get a powerful compounding effect where your dividends start earning their own dividends. It's an incredible way to add a steady stream of passive income on top of the growth from your S&P 500 fund. Investment number 4, be a landlord minus the toilets, REIT ETFs. Our fourth and final investment lets you tap into one of the oldest wealth-building assets on the planet, real estate. But don't worry, I'm not about to tell you to go buy a house, screen tenants, and fix leaky toilets at 2 a.m. We're going to do it the easy way, through a real estate investment trust, or REIT. A REIT is just a company that owns and operates properties that produce income. Think apartment buildings, shopping malls, office towers, or even the data centers that power the internet. The cool part, by law, REITs have to pay out at least 90% of their taxable income to shareholders as dividends. This makes them absolute income-generating machines. And just like our other investments, the simplest way to get started is with a REIT ETF. A great one is the Vanguard Real Estate ETF, ticker symbol VNQ. This one fund gives you a piece of hundreds of different real estate companies all across the country, giving you instant diversification. You get all the benefits of rising property values and rental income without ever having to be a landlord. REITs are a fantastic way to diversify your portfolio beyond just traditional stocks. The real estate market often zigs when the stock market zags, which can help smooth out your journey. Plus, funds like VNQ have historically offered juicy dividend yields, often higher than the S&P 500 and even some dividend funds. It's the perfect final piece to our 4-part puzzle. And final action plan. Look, knowing what to do is great, but it's useless without doing it. My goal isn't for you to leave this video with more information, it's for you to leave with a concrete plan. So here are the 3 simple steps to get started, like today. First, open the right accounts. For your HYSA, check out some reputable online banks. For the ETFs we talked about, you'll need a brokerage account. Great beginner-friendly options in the US include Fidelity, Charles Schwab, and M1 Finance. Opening an account is free and literally takes less than 15 minutes. Second, automate everything. This is the secret weapon for consistency. Decide how much you can invest each month, even if it's just $50 to start, and set up an automatic transfer from your checking account to your brokerage account. Treat it like a bill you have to pay. Pay yourself first. Third, just do it. Once the money hits your account, buy the ETFs. You can decide how to split it up, maybe putting most of it in the S&P 500 fund and smaller chunks into the dividend and REIT funds. The most important thing is simply to start. Starting with $50 is infinitely better than not starting at all.
So that's it. The 4 investments you need to stop losing to inflation and start building real wealth in 2026. Let's make it simple. 1. A high-yield savings account. Your safe, liquid cash for emergencies. 2. An S&P 500 index fund, your primary engine for long-term growth. 3. A dividend ETF, to create a stream of passive income that grows. 4. A REIT ETF, to diversify into real estate and add another income stream. That feeling of being overwhelmed and not knowing where to begin, that stops today. You now have a clear, simple, and powerful roadmap. The secret to building wealth isn't being a genius or timing the market perfectly. It's about consistency, discipline, and letting time do the heavy lifting for you. You have the plan. Now, go take that first step. Thanks so much for watching. If this video helped you feel more confident about taking control of your financial future, please subscribe and hit that notification bell so you don't miss the next one. And let me know in the comments, which of these 4 investments are you most excited to start? Thanks again, and I'll see you in the next one.